In a new essay, Minneapolis Fed President Neel Kashkari says he sees 2 more rate cuts coming from the central bank this year. Steve Liesman joins us now with Mr. Kashkari. Hey, Steve, and hey, Neel.
Good morning.
Thank you, Joe. Let's bring in Mr. Kashkari, president of the Minneapolis Fed. Neel, let's talk about your essay this morning, which is fascinating. And I just want to ask you first about one of the things that you say in your piece, which is that you're concerned that there could be some erosion of the belief in the Fed's commitment to the 2% target. How much should we worry that you guys are cutting rates while you're away from your target? And not only that, don't forecast you hit your target until 2028.
Well, Steve, I don't see the erosion yet. Thankfully, it's not there in the data, but it's something that we need to work extra hard to explain to the public why we're making the actions that we're making, why we're cutting rates right now in light of the elevated inflation that we've all been experiencing for 4 years. So I identified it in my essay as a risk that what could cause inflation expectations to rise if people believe that what we call our reaction function has changed and that we would somehow be okay with 3% inflation. We're not okay with 3% inflation. I'm confident that we are going to get inflation back down to 2%, but these tariffs have pushed inflation back up, and we're having to adjust policy to try to accommodate and keep the labor market strong at the same time.
So, Neel, the old saw is watch what they do, not what they say. What are you doing about bringing inflation back down?
Well, if we look at the underlying components, and I don't get into this as much into my essay, housing services inflation is on a very steady trajectory to come down. I've got a lot of confidence that housing inflation is going to continue to come down. Non-housing services inflation is slowly coming down. It's pretty tied to wage growth, and wages are on a downward trajectory. So I've got pretty good confidence that those two segments are going to continue to come down. The core goods inflation had actually ticked negative at the start of this year. That was very good news. It had been negative before the pandemic. They've now come up because of tariffs. And so it really comes down to, do you believe tariffs are a one-time effect or something more persistent? I'm getting more confident that it's more likely a one-time effect, but it's going to take a couple of years for it to play out.
Another thing you talk about in your essay is the concern that the erosion of Fed independence could lift inflation expectations. I get that concept theoretically, but you don't really see it in the bond market. What's the source of that concern, and why do you think the bond market doesn't seem to care about it?
Well, I talked to a lot of market participants. I talked to folks up on Capitol Hill on both sides of the aisle. I think there's widespread appreciation for how important Fed independence is, both to keeping inflation expectations low and anchored, as also to defending the dollar. Those two things are tightly related. But I also think there's a lot of confidence on both sides of the aisle that Fed independence is important and will be protected, and that the courts also see it that way. You can see the Supreme Court's ruling a couple months ago defending Fed independence. So I think people are betting on the institutions of the country continuing to keep Fed independence, to keep it outside of the short-term political process. And certainly, I think we all want the same.
Neel, couldn't you argue that a cut in rates, a quarter point rate, I mean, if you connect the dots to, okay, you know, money's cheaper, people are going to do more, that's going to cause the economy to heat up. I mean, way down the line, way down the road, maybe it's inflationary. But at face value, why doesn't it make certain things cheaper when interest rates go down? Why couldn't you say it actually might help inflation? And people have started to say that, haven't they, Liesman?
Well, I've heard those arguments, Joe. But if you look at mortgage rates as an example, there's a lot of different things that go into mortgage rates. I wrote in my essay that I think the neutral rate of interest has actually gone up. And if you look at over the past year, the FOMC has cut rates by more than 100 basis points. The long end of the curve has been pretty unresponsive to our short-term policy moves. That tells me it's possible that the neutral rate has gone up. And so it's possible that we cut the short end a little bit over the course of the next 6 months or a year, and it ends up not translating into much movement down on mortgage rates. So I don't think it's one for one that a cut in mortgage rates is going to make things immediately cheaper.
Right. There's other interest rate sensitive factors where it could be. And it's happened again. I mean, it's only 10 basis points, but ever since you cut the 10-year, has actually ticked higher with just barely with the yield. But no one, including, I don't think on the Fed, is anyone complaining about 4.1 on the 10-year after all the worries about, our status in the world and the reserve status. I mean, I would sign on for 4.13. Things are going great in the bond. Things are quiet. The vigilantes are, they're not making a peep with $38 trillion in debt.
Well, yeah, I do write about that in the essay, what the disconnect is from the signals that we're getting from the labor market, which is showing a slowdown. Wage growth, payroll employment, for example, all of those are pointing in one direction, and yet financial markets seem quite exuberant, whether it's the stock market or the bond market. Credit spreads are very low. Meme stocks are back. Those are more signals that tell me, hey, wait a second, maybe policy is not all that tight. Nonetheless, I do take seriously half of our dual mandate that the labor market is showing signs of weakening. And so I wrote in my piece that I thought it was appropriate to cut, but I'm not sure how many more cuts we have to get to before we get back to something that looks like neutral.
Neel, I have an almost personal question, being in the room, if you will, and I think everyone's always curious about independence and politics, and I know you've said repeatedly that politics don't enter these conversations, but with Steve Moran in the room, given his role at the White House and in this temporary role now, and being the outlier also in the room in terms of what he wanted to do with interest rates, did politics enter that conversation?
It really didn't. The FOMC has 19 participants, and every year there's always some turnover with presidents retiring or governors retiring and new people coming in. And this was like any other transition where somebody comes in and everybody says, hey, welcome to the table. We look forward to hearing your contributions. And then everybody went about their business as normal. And so what was remarkable about this meeting is how unremarkable it was. And then obviously the chairman achieved a tremendous consensus, not perfect consensus, but tremendous consensus at the end of the day, which I think is a credit to him.
Neel, I want to get a little down and dirty on the outlook for rates here, which is you say in your essay that you think there's 2 more rate cuts that you would support or forecast for through this year. If I do some simple math on that, and I have a 3% inflation rate, and I have a 3.625 funds rate, I have a real rate of 0.625. You're smiling because I think you think my math is good, right? And I end up essentially at neutral, right? So I'm not putting any additional downward pressure on inflation or breaking the economy there. Why is neutral by the end of the year with a 3% inflation rate the right number?
Well, as you know, we have to try to look forward. It's hard. We get a lot of criticism that we're always looking at data that's backward looking. We do try to look forward on what we can see. As I mentioned earlier, that I've got a lot of confidence housing inflation is going to continue to come down. Services inflation tied to wage growth is continuing to slow. And then I do believe, we're not hearing negotiations of ever higher tariff increases. So I think there's a lot of confidence that tariff rates are probably going to settle around near where they are, and it's going to take a couple of years for the economy to adjust to those. That gives me confidence that the underlying inflation in the economy is likely going to continue to head down. And if you think that monetary policy operates with a lag of a year or 2 years, we try to look ahead and say, where should policy be when these things settle out? And I think that's what I'm trying to do, and that's what most of my colleagues are trying to do.
What about the job market in terms of how weak is weak in this job market? If immigration is slowing down, you talked a bit about that in your essay, and you have a whole bunch of stuff that's happening on the administration or the fiscal policy side. There are people who say, I think there's a St. Louis Fed report, that you could have a break-even rate, which is the rate that's required to keep the unemployment rate steady, of just 50,000, which means within the tolerance you could do zero. How weak do you judge the job market is right now?
I think that the St. Louis estimate is reasonable. I mean, I've seen estimates of 50, 80,000, something like that. Certainly it was, I think, around 80 to 90,000 before the pandemic. And we know immigration has cut the labor force growth by a lot. But we're also hearing, I mean, this is where the anecdotes of all the businesses that we talk to come in. We're not hearing many anecdotes of businesses hiring. We're not hearing a lot of firing, which is good news, but it's more one of everybody's cautious. Everybody's on pause. And I think if they're on pause for an extended period of time with not hiring and not firing, it's somewhat of a fragile labor market is how I would look at it. And so I think the cut that we did this week and that the cuts that we could do for the balance of this year, I look at them more on insurance to just keep the labor market from falling dramatically while it takes time for the underlying inflationary dynamics to play out over the course of the next year or so. So I think it's not a bad labor market, but it's one that I think we need to pay a lot of attention to.
Neel, I want to try a question out on you, which I think is a legitimate question in the following way. You guys don't like to comment on politics, but you do say that you take the administration fiscal policy as it's given to you. The administration now and Congress have passed this tax cut. One of their big criticisms of the Fed is your failure to incorporate what they believe will be a supply-side boom that will be non-inflationary growth. Should the Fed be incorporating that more into its outlook and say, you know what, because all that capital investment is coming, we can afford to be looser on policy? And is that a failure? Is that a political decision on your part, I mean the FOMC's part, not to incorporate that in your outlook?
Well, I think it's certainly possible that that's true, and I certainly hope that it, in fact, proves to be true. I put more weight on the forecast of the economy that I have a lot of confidence in. I talked about housing inflation, for example. We can map lease growth a year or two forward, translating into housing inflation. That's what gives me, lease growth has really plummeted back down to pre-pandemic levels. That gives me a lot of confidence that housing services inflation will continue to fall. What are these pro-growth dynamics of the tax cut? You know, if we end up having a lot more capital investment, by the way, that likely will push up R star. And that likely means we have less room to cut before we get back down to neutral. So I'm not against it. I hope it's true. I hope we see a booming economy and a huge productivity surge. But forecasting that with confidence, it's hard for me to do that. And you can't just say it's pro-growth and it's not also going to boost R star. I mean, if some of these things move, other things move along with them. And that's why I think it's prudent to be cautious before we fully assume that they're going to happen.
What's amusing about that, Neel, is I asked AI what kind of impact AI would have on interest rates, and AI told me it would, at least in the short term, raise interest rates because of the capital needs. So you're backed up by that. What about AI, though, Neel? I want to get a final word from you. Are you guys preparing for this notion there could be, I mean, especially when it comes to white collar and new grads and people coming out right out of college now and being having trouble getting work? What is the Fed policy response in that context?
I mean, I think we're watching it. It's going to affect, just like the immigration flows. We know immigration, just as an example, the immediate closing of the border has dramatically changed the break-even rate of job growth, just as you talked about. My guess is the AI effects on the labor market are going to be much slower than that. You know, I'm bullish on AI, but I also remind myself that 5 or 7 years ago, all the bullish talk about self-driving cars and trucks told us that they said all the long-haul truck drivers are going to be out of work in a few years. That's not remotely been true. That doesn't mean that self-driving cars are not eventually going to get here, but usually these things take a lot longer than the proponents suggest. So I'm bullish on AI. We have to watch it carefully. But so far, I'm not seeing evidence that it's affecting the labor market as much as other policy developments are affecting the labor market.
We have to go, Neel, but real quick, what did you think of your colleagues' Dot calling for 350 basis point rate cuts?
We have 19 participants with a wide range of views, and everybody's contributing to the discussion.
Neel, thanks for joining us this morning. Neel Kashkari, Minneapolis Fed President.
Thanks for having me.
Joe, what do you think? You satisfied?
He's got a
riff, right?
Yeah, yep. I feel calm.
Confident inflation's coming down.
How do you feel about him saying that this meeting was, the remarkable part about the meeting was how unremarkable it was?
That's a good line.
We did go in with some people estimating you could have an 8-3-1 vote.
Right.
8 for a quarter, 3 for 50, maybe 1 dissenting. And Powell pulled it together. I'm really not sure if that's how important that is. He thinks that's important. I don't know if I should second guess him on that, but it's an interesting question. Why not have an 8-3-1 vote if that's what people want to vote? He thinks it's important for the Fed, I guess, institutionally, to show consensus.
But it also just sounded like it wasn't that dramatic. I mean, I would have thought if you were going into a room like that, there'd be conversations about what's going on with Lisa Cook.
Just
people would be talking about Steve Moran, right? Like
Myron. Spread the blame. Yes,
It's
Stephen
Bernanke rhymes with Yankee. Myron rhymes with Byron. I don't know.
Go.
We're going to spread the blame. The blame
We're going to
around.
be talking to him
9-0.
later. We're talking to him later, you know.
Today.
Byron.
Awesome.
On another show.
Coming up,
thanks.